One second. So, thank you, Sanjo, and thanks to Works for the excellent efforts. Okay, so let's hi in the chat box, all of you, the participants. So we'll just start in 2 minutes, but meanwhile, let's warm up. Okay, so one second. Hope you all can see the presentation. Yes, it's visible, right? Okay, cool. So one second. Okay. So is my voice clear? Okay. So one sec. So all of you, just put a hi. Just so let's start. So today is a class on introduction to technical analysis, right? So we would thank Newbee Works on this excellent process of educating the people and recognizing Stockathon. So we are going to start this session and just yeah, muted. Okay, let's go ahead. So today's let me skip this. Let me come back to this later. So basically, you need to understand two things very importantly before even we go into the technical analysis. The difference between fundamental and technical analysis and the importance of fundamental and technical analysis. These are the two important questions in order to proceed with the technical. The first point here is what is the difference between fundamental and technical analysis, right? Then the importance of fundamental and technical. So I will move towards the whiteboard to show you better. One second. Okay. You share this screen. Okay, can you all see the screen? Whiteboard? Yeah. Yes. So the basic difference between fundamental analysis and technical analysis is very important. Fundamental analysis is the actual performance. Okay. Technical analysis is the performance happening to the supply and demand. This analysis is nothing like your academic performance. Technical analysis is like uh, your tests, entrance tests, or have the round and all those all compute to the technical analysis, where you have been tested on your IQ and EQ. Here you have tested on your logical understanding, that is the academic. So a person can be employed by the employer only if these two match. Only if these two are effectively performed, you can have the ability to get employed. So similarly, many people ask, sir, do we require fundamental analysis? Do we require technical analysis? Actually, we require both, because you are finding your candidate is none other than your stock that you are looking for, right? So we are very, very understanding here what it is the we should be very clear on which stock are we choosing. If a stock on fundamental analysis followed with a technical analysis, that only will give the or ability. The second important aspect here is, one second. Now people always have 20-10 and 70-20-10 formula. So usually 70% an investor or a trader invests in execution. He he only in executing. The remaining 20% of the time he goes into monitoring phase or observing phase. Thus remaining 10% looks at the analysis. It looks at the analysis. This is general 25% of the in stock market follow this process. As all have many have heard that only 5 to 10% of the people are making money in stocks. Only behind this 95% of the people and this 5 to 10% of the people is they follow a reverse process. The 5% of the people, 5 to 10% of the people follow the reverse process, meaning 70% of their time they utilize in analysis, 20% of the time they utilize in monitoring the stock, 10% in execution. Okay, so analysis, monitoring, and execution. But the general public who are called have not been successful is because they are following, they first trade, then they start monitoring the stock, then they realize, yo, this stock had to be bought, but I have sold, or it has to be sold, I have bought. So this is the major difference between the 90% of the people who are not successful and 10% of the people who are successful in the stock. So please try to implement. That is where we have come here to emphasize you on how important is the technical analysis. So in analysis, you have two types: fundamental, technical. That is where we are coming to. In fundamental analysis, you are going to find the characteristics of the company's background, company background, performance, credibility, and sustainability. Right? This is what you are studying with the help of a fundamental analysis. In technical analysis, you are trying to find supply and demand, entry, exit process. So there is an ample of difference between these two, the fundamental and the technical, right? So we have to be very clear on what purpose are we using this, right? So with this basic understanding, I am going to the, once again, let me come back. Okay, all of you can we will take it up at the end of the session. Okay. So, what is technical analysis? It is the study of the past action to predict the future price trends. It is the study of the past action to predict the future price trends. Works best in the stocks that have a mass following. Mass following here means the people who are having good volumes. Here, the mass is nothing but volumes. Is based on the law of demand and supply, completely based on the law of demand and supply and mindset of the masses. This completely depicts the mindsets of the masses. Clear? So based on that, we are trying or using the technical analysis on a bigger scope. So it is a past performance which predicts the future value and works best which has good volumes. It is a law of supply and demand and depicts the mindset of the masses. Here, masses are nobody other than the people who create the trend or who are the volume creators in the markets like FIIs, DIIs, FPIs, HNIs, and PCGs. So, all these people are the dominant players in the market, then followed by the retailers. So it is always good to follow the mass rather than following the retailers, right? The here the masses are the people who are actually creating the trend in. Okay, so followed with okay. Sanjo. Yeah, yeah. So, how many participants are there? I don't see. I don't see. Okay, okay. So we'll do one thing. We will proceed it later, no? Hmm. Okay, okay. Hmm. Okay. Cool, cool, cool. So the agenda here is we are trying to understand the type of technical analysis that we have to look at. Then followed with should I buy today? And these are the certain questions that are actually being questioned. Should I buy today? What price should I buy it? What will be the price tomorrow? What might be the price next week or month or year? So based on this, only the entire technical analysis works, right? So, if you generally see any kind of a technical analyst talking about the technical analysis, these are the major components or the factors that are considered in. That's where we are trying to decode here. Basically, there are two types of analysts. As I told, let us not follow 90% of the people, rather try to follow on the 10% of the people who are successful in stocks, right? Basically, there are two types of analysts, that is predictor and trend follower. The predictor is the one who actually tries top and bottom and finds the trend reversal dates, precisely what is happening in the stocks and all those. Trend follower is a someone who just follows the trend. If it is an uptrend, he just buys. If it is a downtrend, he just exits the stock or he goes short in the stock. So the predictor usually tries, he buys at the bottom, he sells at the top, and he can go in detailed in order to find the trend reversal dates also. So the predictor is somebody who works on quantum, the data or the numbers, and trend follower is somebody who works on the charting like the candlestick, Renko, Heikanashi, Ichimoku, and the predictor are examples like WD Gyan, where he used to work on a lot of numbers. And trend followers are somebody like Munushi Homa, who used to always try to follow the charts, right? So these two, what is the major difference if you ask me between the predictor and trend follower? Predictor works on the quantum, trend follower works on charting. Simultaneously, predictor predicts the date and time the trend reversal is going to happen. So a predictor comes with knowledge and experience. A trend follower comes with a knowledge. Slowly, once he gets that experience out, he slowly becomes a predictor. So, always a newcomer in these stocks should look at trend follower, right? So, these are types of charts, that is line charts, bar charts, and candlestick. We are going to study now. The candlestick charts were not introduced now; it was introduced at 17th century. Simultaneously, Munushi Homa, who was the person who is called as the grandfather of technical analysis, was introduced, and 100 consecutive winning trades. Only based on that, he was recognized in the entire gamut of something which is going to create a. So this is a time for gratitude that he has introduced this to the entire world, right? So basically, there are two types of candles. That is bullish candle and a bearish candle. So let us go in depth to understand this. One second. Okay. Okay. So bullish, bearish, bullish candle and bearish candle. Bullish candle is basically represented as an uptrend candle, and bearish is represented to be a downtrend candle. That is, a stock has an uptrend, it is called as bullish. A stock which is in downtrend is called as a bearish, right? Followed with, what is a candlestick? A candlestick has four parameters, that is open, high, low, and close. Assuming you are taking a candle, it will consist of open, high, low, close. Open, high, low, and close. That's where they brought in a concept. A candlestick chart has open, high, low, and close. If we take at 9:15, the open price is determined. That is, the market starts at 9:15 and closes at 3:30. So at 9:15 a.m., you are receiving the open price. At 3:30 p.m., you are receiving the closing price. Okay. In between, you get your high and low. Okay. Hope this is clear. Now let's go further to understand. So open, high, low, and close. So a candle consists of open, high, low, and close. So a candle basically represents like this. Okay. If the close is greater than the opening, it is called as a bullish candle. Similarly, if a close is less than the opening, it is called as bearish candle. I'll discuss in detail how to determine this. Now let us take an example. If the stock opened at 100 rupees, made a low of 95, okay, and closed at 110. So how do you represent this in the candle? Firstly, since the closing is greater than the opening, it is a bullish candle. So how do you represent this, or how do you plot this? Now, first, as I told you, this happens at 9:50. So first thing that will be plotted, the close happens at 3:30. So this happens at the end of the day. So first I will plot the opening 100. This is open. Then I will plot the high, that is at 125. This is the high. Then I'll plot the low. This is 95. And the close should be between 100 and 125, right? So I plot this as 110, which is the close. So I will connect the open and close and connect the highs and the lows. Connect the highs and the lows and connect it to the real. This is called as the real body. This is called as the wick, upper wick. This is called as the lower wick. Okay. This is called as the upper wick. This is the real body, and this is called as the lower wick. Okay. So here, close is greater than the opening. That is why this is represented or called as a bullish candle, right? Followed with the assuming a stock opened at 100, made a high of 125, made a low of 8 and closed at 90. If we have to represent this, first what will we plot? We'll plot the open. So open is at 100. Then we'll plot the high. 1 at 125. Then we'll plot the low, that is at 80. Then when we have to plot the closing, that is at 90, we'll have to plot at closing 90. Okay. So when you are connecting the open and close and connecting your highs and lows, since the closing is less than opening, that is C is less than the opening, this is represented in form of a bearish pattern. That is because this is nothing but the real body. This is the upper wick, lower wick, and close is less than the opening. So we do this as a bearish candle. Okay, this is termed as bearish candle. Okay, so let's go back to the slide. Okay, so if you see here, high will remain as the high, low will remain at the low place. The only interchange between the bullish candle and a bearish candle is you are having the close greater than the opening in the bullish candle, and in the bearish candle you have close less than the opening. Okay. So there is a small assignment for you all where you can work at your home place, where try to draw or plot. First what you do is try to plot the open, high, low and close, and connect with a square box or a rectangle box the real body. You will get the real body by connecting the open and close, and then connect the wicks with the help of connecting your open and low or high, and connecting your close with low or high. So you will get a candlestick. If the closing is greater than the opening, then that particular candle is called as a bullish candle. And if the closing is less than the opening, then it is called as a bearish candle. So this is a basic introduction to technical analysis. Maybe in further courses of time, we are going to give in detail, because this is a webinar. We want to give a portion of the content where this is just an introduction, and why is technical analysis very important, and how technical analysis or the candlestick is formed is the agenda. So this is a small activity for you all, for you to do it. So let's plan, and you can give a try. And first process to form this candlestick is form and plot the candles, then draw the real body, connect the upper wick and the close is greater than the opening, then that particular candle will be a bullish candle. If the closing is less than the opening, then that particular candle will be considered as a bearish candle. Okay, so this is how I've just given a tip of the iceberg today, because technical analysis is an ocean and very very interesting concept. And since my passion is to train on technical analysis, and I'm also a SEBI registered research analyst. The entire 14 years I have been into complete technical analysis. Okay, so maybe in further course we are going to go in depth and give you clarity on step by step into the technical analysis. Okay, fine, great. So, Sanjay? Yes, sir. So, we'll wind up. Okay. So, we will plan it and then, okay.